Hello everybody, how are you doing? It's me, Kenya. Today is Tuesday, March 31st, the last day of March. I'm at home, and in my free time, I'm going to read my tax guide book. This is the Tax Guide 2020 edition. While I'm going to start reading any second, and so while I'm waiting for folks to come into the live stream, please feel free to mingle amongst yourselves. Share out the live stream if you're able to do it on like Facebook or Twitter, something like that. Let's see, like the video and just give me a few minutes. I'm just doing some last minute things before I come on here. I'll probably be reading about an hour or two. And so yeah, get yourself a refreshment and something to snack on. Get your notebook. Get your pen and paper, and if you got any questions, hopefully I can find the answers in here. I am not giving legal advice. I am only literally reading the Essential Tax Guide 2020 edition. Tomorrow's April 1st, and so tax season is right around the corner. Hopefully I can help some of you guys out who may not know something that we can all learn together in here. All right, in just a second, this video is going to loop. And in the meantime, you guys stick around, give me that thumbs up, please consider subscribing if you haven't already, and I will be right back to read the Bible. No, that's in the morning. I read the Bible in the morning. Right now I'll be right back to read the 2020 tax guide. Hello everybody, how are you doing? It's me, Kenya. Today is Tuesday, March 31st, the last day of March. I'm at home, and in my free time, I'm going to read my tax guide book. This is the Tax Guide 2020 edition. But I'm going to come on here and start reading any second, and so while I'm waiting for folks to come into the live stream, please feel free to mingle amongst yourselves. Share out the live stream if you're able to do it on like Facebook or Twitter, something like that. Let's see, like the video and just give me a few minutes. I'm just doing some last minute things before I come on here. I'll probably be reading about an hour or two. And so yeah, get yourself a refreshment and something to snack on. Get your notebook. Get your pen and paper, and if you got any questions, hopefully I can find the answers in here. I am not giving legal advice. I am only literally reading the Essential Tax Guide 2020 edition. Tomorrow's April 1st, and so tax season is right around the corner. Hopefully I can help some of you guys out who may not know something that we can all learn together in here. All right, in just a second, this video is going to loop. And in the meantime, you guys stick around, give me that thumbs up, please consider subscribing if you haven't already, and I will be right back to read the Bible. No, that's in the morning. I read the Bible in the morning. Right now I'll be right back to read the 2020 tax guide. Hello everybody, how are you doing? It's me, Kenya. Today is Tuesday, March 31st, the last day of March. I'm at home, and in my free time, I'm going to read my tax guide book. This is the Tax Guide 2020 edition. While I am going live, this part right here is actually pre-recorded, so yeah, give me a few minutes. I'm gonna go live any second. Well, if you're watching this, I am live, but I'm gonna come on here and start reading any second. And so while I'm waiting for folks to come into the live stream, please feel free to mingle amongst yourselves. Share out the live stream if you're able to do it on like Facebook or Twitter, something like that. Let's see, like the video and just give me a few minutes. I'm just doing some last minute things before I come on here. I'll probably be reading about an hour or two. And so yeah, get yourself a refreshment and something to snack on. Get your notebook. Get your pen and paper, and if you got any questions, hopefully I can find the answers in here. I am not giving legal advice. I am only literally reading the Essential Tax Guide 2020 edition. Tomorrow's April 1st, and so tax season is right around the corner. Hopefully I can help some of you guys out who may not know something that we can all learn together in here. All right, in just a second, this video is going to loop. And in the meantime, you guys stick around, give me that thumbs up. Please consider subscribing if you haven't already, and I will be right back to read the Bible. No, that's in the morning. I read the Bible in the morning. Right now, I'll be right back to read the 2020 tax guide. Hello everybody, how are you doing? It's me, Kenya. Today is Tuesday, March 31st, the last day of March. I'm hashtag at home, and in my hashtag free time, I'm going to read my hashtag tax guide book. This is the Tax Guide 2020 edition. While I am going live, this part right here is actually pre-recorded, so yeah, give me a few minutes. I'm gonna go live any second. Well, if you're watching this, I am live, but I'm gonna come on here and start reading any second. And so while I'm waiting for folks to come into the live stream, please feel free to mingle amongst yourselves. Share out the live stream if you're able to do it on like Facebook or Twitter, something like that. Let's see, like the video and just give me a few minutes. I'm just doing some last minute things before I come on here. I'll probably be reading about an hour or two. And so yeah, get yourself a refreshment and something to snack on. Get your notebook. Get your pen and paper, and if you got any questions, hopefully I can find the answers in here. I am not giving legal advice. I am only literally reading the Essential Tax Guide 2020 edition. Tomorrow's April 1st, and so tax season is right around the corner. Hopefully I can help some of you guys out who may not know something that we can all learn together in here. All right, in just a second, this video is going to loop. And in the meantime, you guys stick around, give me that thumbs up. Please consider subscribing if you haven't already, and I will be right back to read the Bible. No, that's in the morning. I read the Bible in the morning. Right now, I'll be right back to read the 2020 tax guide. Hello everybody, how are you doing? It's me, Kenya. Today is Tuesday, March 31st, the last day of March. I'm hashtag at home, and in my hashtag free time, I'm going to read my hashtag tax guide book. This is the Tax Guide 2020 edition. While I am going live, this part right here is actually pre-recorded, so yeah, give me a few minutes. I'm gonna go live any second. Well, if you're watching this, I am live, but I'm gonna come on here and start reading any second. And so while I'm waiting for folks to come into the live stream, please feel free to mingle amongst yourselves. Share out the live stream if you're able to do it on like Facebook or Twitter, something like that. Let's see, like the video and just give me a few minutes. I'm just doing some last minute things before I come on here. I'll probably be reading about an hour or two. And so yeah, get yourself a refreshment and something to snack on. Get your notebook. Get your pen and paper. Tomorrow's April 1st, and so tax season is right around the corner. Hopefully I can help some of you guys out who may not know something that we can all learn together in here. All right, in just a second, this video is going to loop. And in the meantime, you guys stick around, give me that thumbs up. Please consider subscribing if you haven't already, and I will be right back to read the Bible. No, that's in the morning. I read the Bible in the morning. Right now, I'll be right back to read the 2020 tax guide. Hello everybody, how are you doing? It's me, Kenya. Today is Tuesday, March 31st, the last day of March. I'm hashtag at home, and in my hashtag free time, I'm going to read my hashtag tax guide book. This is the Tax Guide 2020 edition. While I am going live, this part. Good morning. Good morning. I don't know what time it is where you're at, but no matter what time of day it is, I say good morning. People who work with me, people who know me know that that's what I say. I say good morning. Good morning. I say it just like that. I know I get on a lot of people's nerves, but I also bring a smile to a lot of people's faces when I say that. So I will say that to you. Good morning. And I hope I bring a smile to your face. So today, while we hashtag stay at home, I am going to be reading a magazine. And if you are interested in watching me and listening to me read a magazine, then you are most welcome to do so. Tax season is right around the corner. I should have read this like a week or two ago for you guys. Of course, I was going to put it together in a neat little package. of a video, like a recorded video, but I said, you know what? Why not? Just why not? Why not? I got a lot of extra windows open here, so I want to make sure that my live stream doesn't get unnecessarily slowed down. And I should probably check to make sure I can hear myself, since this is a all brand new live stream. I can hear myself very well. And so, yes, let's get started. Let's get this party started. Yeah. All right. Some of you may not need this information because you have never filed taxes before. Maybe you're tax exempt. But if you want to just come on in and listen to the sound of my voice, you're welcome to do that too. I got my bottled water ready because last time I did a lot of reading, I started to lose my voice a little bit. I've got my hot tea, and it's mint blend. Look at that. Mint. I don't know if you can see that. Mint blend herbal tea. Oh, I forgot to share this out on my Facebook. Give me 1 second. Let me share it out on Facebook because there's probably some folks that might be interested there. And yeah, I really don't want to talk about the subject at hand. There's so many people talking about it already. There's so many YouTubers making videos on it, whether it's good information or bad information, or they're doing it just for views. I don't even want to talk about it. So I do have particular words like on my banned list, so don't even bring it up. It's not gonna pop up in the stream because YouTube is actually frowning on that nowadays. They don't want it to be on the platform as much. Also, if you're trying to monetize your channel, it's probably not a good idea to put it on there because it is considered by YouTube to be a sensitive topic. I'm not talking about sensitive topics. I am talking about money, 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 money. I repeat, I am not giving out legal advice. I'm not giving out tax advice. I am literally reading my magazine. So hopefully I can learn something and you guys can learn something too. If you learn something, share it with a friend, share out the live stream, let folks know. And yeah, that's about it. Hello, Kenya. Can you do something on retirement? Life of Key was the early bird. Said, hey, good afternoon. Actually, I think there was something on retirement here. So let me get my pen because I want to make sure I mark things off as I go through them. I'm only going to be on here for about an hour, guys. So let me set my timer. And since there was a request, I am going to look in there for the retirement information. Timer is set for, I'm going to put it for 2 hours and 5 minutes just so I can give myself some time to wrap up. I probably should have charged my phone. Hopefully Hopefully I won't run out of any juice. I am doing, let me see. I just got a text message in. I need to put my do not disturb on, like someone told me. I'm in the middle of a live stream. I'll be done in about 2 hours. And let me see, how do I even put do not disturb on here? I don't think I've ever done that on this new phone. Do not disturb right there. Booyah. And I'm going to put my timer on because even right now the time it's taking me to do this is like 5 minutes. So it's a good thing I put it on 2 hours and 5 minutes. All right. Do not disturb right there. Booyah. Booyah. All right, so let me get my timer so you all can help keep me accountable. I don't know if you can see that. Push that back a little bit. When that goes off, I'm going to stop reading because I got stuff to do. Well, you can't see that at all. No, you can't really see that at all. But that's okay. I know it's there, and it'll be playing in my ear. All right. Somebody said something about retirement. Let's see what this magazine has got on retirement issues. I know I saw it in the table of contents. So we got Tax Income 101. We got today's tax laws, getting started, can't miss tax moves, taxes in the USA, next year, tax action workbook. Where did I see that at? Here we go. Page 67, about retirement savings and taxes. Hold on, you know what? I'm just going to read through the entire table of contents. If you hear something that sounds interesting, let me know in the chat room. Talk about that one, but let me make sure I don't miss anything. So section 1 talks about, page 7 says, what is a progressive tax code? That's interesting. What is a progressive tax code? On page 9, it says how to know what is taxable. Page 11, understanding tax credits and deductions. In section 2, under today's tax laws, it says the lasting effects of the TCJA. I have no idea what that is. TCJA, that's on page 15. 1 year later, the TCJA's biggest mistake. What in the world does that mean? Hold on a second. I have a feeling that has something to do with what Trump has put into effect. The TCJA is the Tax Cuts and Jobs Act. Tax Cuts and Jobs Act. So if you see me using this term, I'm gonna put in the live stream. TCJA equals, what did I just read? Sorry. Tax Cuts and Jobs Act equals Tax Cuts and Jobs Act. Okay, so if you hear me use that term, TCJA, that's what that means. Let's see, page 20 says other important changes. Page 22, pay attention to these small changes. In section 3, we got file your own taxes or hire a professional. We've got keeping your tax documents organized. We've got getting organized. Should you use print or digital? Page 34, it talks about types of income and how they are taxed. Types of income and how they are taxed. Page 36 says income tax forms and how to read them. Page 40 is choosing your filing status. Do you know what your filing status is? Have you changed it over the last couple of years? Has it always been the same? I personally file as head of household. I'm not married, but I do have dependents, and so I always file as head of household. Page 43 talks about top 7 questions about tax deductions. Page 47 talks about common deductions and credits. Page 50 talks about lowering the chances of an audit. Nobody wants to be audited, right? Nobody wants to be audited because once the IRS audits you, I think it becomes a regular thing. Page 53 is talking about extensions, all about extensions. Okay, now we're on to section 4 of the table of contents. Welcome to the room, everybody coming in. If you don't have anything to say, just leave me your thumbs up and listen in. I'm reading through the table of contents for this tax magazine. If you hear something interesting, let me know and I'll be reading it. The first thing I'm going to read is about retirement since somebody requested that. Okay, section 4, these are can't miss tax moves. Page 57 talks about hitting the tax withholding sweet spot. I've always wondered about that. When you're putting your tax withholding, some people put a huge number because you get more money back during your checks. Other people put a small number because they want a bigger refund at the end or something like that. So that would be interesting to read. On page 58, it talks about your new W-4, your new W-4. Page 63 is the tax incentives of home ownership. I've been a homeowner for 3 years. I have a feeling I have not taken advantage of everything, so hopefully I'll learn something new and hear about that. Page 65 is talking about rewards for do-gooders. Rewards for do-gooders. 67 talks about retirement savings and taxes. That's going to be the first thing we hit for Laverne Dorsey, who requested that. On page 7, it's talking about understanding taxes on your investments. Anybody in here invest? I don't, not yet. I mean, I've used Robinhood, the little app, investment app, but I really don't know as much as I wish I knew. Page 72 talking about is an SHA right for you? I have no idea what that is, so I'm going to look it up really quick. What is an HSA? Health and savings account. Health and savings account. So I'm going to put that in the live stream as well. HSA equals health and savings account. So that's what that means. So if you hear that term, that's what I'm talking about here. Page 75 talks about estate taxes and passing money on to your heirs. Page 77, what's estimated tax and who pays it? Page 78 is talking about beware of tax scams. Now we're on to section 5, talking about taxes in the USA. Page 81 says the state of state taxes. What is the state of state taxes? Page 86, taxes state by state. Page 88, how to minimize taxes if you live in a high tax state. Page 90 is top states for a tax-friendly retirement. And page 92, that might be something else you were interested in. Laverne Dorsey requested that. So as soon as I get done reading, what did you ask about? Page 67 talks about savings and retirement taxes. As soon as I get done with that one, I'm going to go on to this next one since you requested that. So I'm going to go from page 67 on to page 90, talking about tax-friendly retirements. For those 9 viewers in the house, welcome. Thank you so much. Don't forget to give me a thumbs up. It really does help the live stream. It helps it become more discoverable. So other people who are interested in learning about some tax guides for the year 2020, they'll be able to find me better. All right, and page 92 talks about new for 2020. New for 2020. Section 6 is talking about next year. Page 95, update your W-4 after a life change. You guys know what life changes are, right? The death of someone, the life of someone, getting married, getting divorced. I want to say there's something else in there, adopting a child. So when you have a big life change, those are the types of things that you need to be mindful of when you are filing your taxes. Page 96 talks about get strategic about bunching deductions. I have no idea what that means. Page 99, keep up with your quarterly taxes. So I am a small business owner. I consider myself a micro business owner because my eBay store, it does not make very much money, but it is, I do business. I have a DBA for my MLK Goodies eBay, also for my YouTube, which is still not making money, but it is something that I have to file quarterly taxes for. And every time I file them, I tell them I made no earnings, but you still have to file. Having a child, yes, having a child is a life change. So before you were a parent, you filed one way. Now that you are a parent, you're going to file a different way. That's something to be covered in there. Let's see. Page 101 is talking about plan your capital gains and losses. Page 105, save for retirement. Page 106, organize records as they hit your inbox. I do that. Since I sell on eBay, and my account is hooked up with PayPal, whenever I get a new, like, they will give me notifications. Hey, you just sold this hat. Hey, you sold the teddy bear. And then I make up my shipping labels through PayPal, and every time I pay, well, when somebody gives me their money for those things that I'm sending off, that goes into one folder. I put that in my income box or my profit folder. I have a little folder, and then when I pay for those shipping labels, I make sure I save all those through PayPal. PayPal saves them too, but I save them in my own folder. So organize records as they hit your inbox. Page 109 talks about take advantage of special tax provisions. I need some special tax provisions. Okay, this is the final section. Section 7 says take action workbook, and there may be something in the back of here. I have a scanner. It doesn't work half the time, but if I can get my scanner to work, I'm going to see if I can make a copy of some of this stuff, and I will put it up on my, if I'm allowed to, if that's not copyright infringement, we'll see. The tax forms I should be able to, but if I can put some of the other stuff, I'll put it up on my website, 40entp.com. I haven't updated it in a while, but I think that would be some helpful information. All right, let me finish reading through this last section before I start reading. Page 111, what you need to file your taxes. Page 112, tax form checklist. Page 114, your marginal tax bracket is. Do you know what tax bracket you're in? I do not. I feel like I'm in the second one. There's like, what is it, 10 to 15%? Actually, it's changed recently, right? Since Trump has come into office, the tax brackets have changed. But there's like 4 tax brackets. I'm not in the bottom one. I'm sure not in the top one. I think I'm in the second from the bottom. But do you know what your tax bracket is? Just let me know in the chat room. Yes or no, or I'm not sure. And you can also let me know that on the replay. Do you know what your tax rate? You don't have to tell me what it is. Just let me know if you know what it is. Page 115, home office expenses. This is kind of my home office. This portion of my home is for my YouTube channel, my YouTube business. So this would be a write-off. Also, my warehouse, aka the half of my garage, is also part of my work office. So that would be something that would be included in here. Business expense tracker is on page 116. Charitable giving is on page 117. Medical cost tracker. Do you have a lot of medical expenses? Some of those things can be written off. Maybe they will be covered in here. Page 119 is how long to keep your tax papers. Somebody was just asking me that. So I might jump onto that one first just to have that question answered, and then I'll jump into the retirement information. How long do you keep your tax papers? Wow. Page 120, what's eligible for an HSA? If you look in the chat box, I put HSA is a health and savings account. Let's see, important tax dates throughout the year. Page 121. 2020 tax planning, so not this year. This year you're going to be filing for your 2019 taxes. Next year you're going to be filing for your 2020 taxes. And finally, on page 123, we have track your 2020 freelance income. I would love to be a freelancer. And actually, as far as my voiceover stuff, speaking of my voice, let me wet my whistle. Speaking of my voiceover stuff, the voiceover stuff that I'm trying to get into could be considered freelance work. People who want a narrator for a game or any kind of thing, you're just doing gigs here and there. So that would be considered freelance work. All right, number 1, let me jump on in. I've never used this pen before, so I had to take the little wax bubble off. Let's see, page 67 is talking about retirement savings and taxes. Page 90, top states for tax-friendly retirement. Page 105 is how to save for retirement. And then what was that other one? How long should you keep your tax papers? Okay, I got 3 different items here on retirement, and I've just got one on this how long to keep your tax papers. So I'm gonna jump into that one. Possibly 7 to 10 years. That's what I'm thinking. I'm gonna read that one first since it's just one little article, and hopefully that will answer the question to the person who asked, how long do you keep your tax papers? And in case you were wondering what magazine I'm reading, if you're able to get out to your local magazine supplier or store, this is what it looks like. It is the Essential Tax Guide 2020 edition. This should be out until April 6, 2020. That's what it says on the bottom of the magazine. Yeah. See that there at the bottom? Display until April 6, 2020. And yes, I really did pay $12 for this. Information is expensive, you guys. Real information. I was just talking to somebody else today about how do you know what's real and what's not real. Chances are, if you gotta pay for a book and read it, it's more than likely true. Stuff on the internet, it's hit or miss. All right, let's get into it, ladies and gentlemen. How long to keep your tax papers? Documents as long as there is a chance that the IRS might decide to audit you. The IRS generally has 3 years to make that choice, but under certain circumstances, it can look back even further. I'm going to hold that up to the screen just so you can see that. Right there it says, it's important to hold on to your tax documents as long as there is a chance that the IRS might decide to audit you. The IRS generally has 3 years to make that choice, but under certain circumstances, it can look back even further. Here are some guidelines to help you figure out how long to keep tax-related papers. For 1 year, pay stubs, your pay stubs. You can shred them once you've received your W-2. So usually that first month, January up until January 31st, you get your W-2s, and that will give you all the information for that previous year that you had. Pay stubs, keep your pay stubs for at least 1 full year, and once you get your W-2s and confirm that they are accurate, you can shred them. It says here, take action. Tear out and place this guide at the front of your tax file. When you add each year's tax records to your file going forward, review and shred your old records as necessary. So they're telling you to literally pull this out, put it into whatever document or folder that you're using, and then at the end of the year, when you get the tax year's records to your file going forward, review them and shred everything old. Okay, what do you keep for 3 years? What do you hold on to for 3 years? This is the layout. This is what I'm reading here. If anybody ever wants to go back, you can go back and pause. Go back and pause the video at this point so you can see what I'm holding up. 1 year, 3 year, and 7 years. Okay. For 3 years, you need to hold on to all supporting records for each year's tax return. All supporting records? What does that mean? What is a supporting record for each year's tax return? W-2s, 1098s, and 1099 forms, charitable donation receipts. I just unloaded a bunch of stuff. If you guys watched me a couple weeks ago, I unloaded a bunch of stuff from my eBay inventory to my local Goodwill. And yes, I did get the little slip for me to itemize those deductions. Charitable donation receipts, including any appraisals, child care and education costs, including tuition, room and board, and fee information. So if you've got little ones that you pay child care for, make sure you keep all those daycare receipts. If you send your child to a private school or even tutoring, make sure you keep those those receipts. If you have a college student that is living on campus, that is boarding, or if they go to a boarding school, that is boarding and any fees that have to do with their education. Also, make sure you keep for 3 years your medical receipts. Your contributions to tax deferred retirement accounts. Do you have a 401k? Do you have an IRA? Those types of tax deferred savings, you want to keep those contribution receipts for 3 years. Do you volunteer? Volunteer time cards and mileage documentation. So yeah, if you volunteer, you're volunteering your time and you're volunteering your gas mileage to go from place to place. Keep track of those and keep those for 3 years. How about any business expenses that you may have? Receipts for office equipment, like this Dymo. I'm going to show you my Dymo printer that I've got. This is what I use for my eBay business. Oh, I might have to unplug it to show you. It's plugged in right next to me. When I ship my items on eBay, I use this Dymo label. It's really dusty. I use this Dymo label writer, and I think this cost me maybe $150. I don't really remember. I honestly don't remember. But this would go on this year's tax forms because I bought this last year. This is for my eBay business. I treat it like a business. It's registered as a business. This was purchased for the purpose of my me shipping off on eBay. So that's something that would be considered equipment. I've got a light ring that's in front of me right now to keep me illuminated. That's part of my YouTube business. No, my business is not making money right now because I'm not monetized, but I specifically bought this light ring for my YouTube business. That is equipment. What else do we have? This little sign that I got last year. I think I went to buildasign.com, something like that. Buildasign.com. It was $14.99. It's actually like, it's corrugated plastic. You know, like corrugated cardboard. That's how this is made. It's corrugated plastic, real lightweight. I used to have it pasted up on my wall. Now I just got it here. This, it's not equipment, but it is a business expense. This is a promotional expense. When people are watching me and they see that, I am promoting myself. Any of the t-shirts that you guys see me wearing, my 40 Entrepreneur Drive t-shirts, I buy those online, but I did have one local person make me some t-shirts. So it's not equipment, but is a business expense. That is for my YouTube channel. What else can I think of? I can't think of anything else right now, but I'm just trying to give you guys some examples of things that are like equipment. What else would be equipment? For my voiceovers. Last year, I bought a microphone package. It was a bundle. It was the microphone, the headphones, the little stand to put the microphone on, and some software so that I can edit. That is business equipment for my voiceovers, which is like a whole separate business of mine. All right, let me go on here. Business expenses, receipts for office equipment and supplies, mileage, utility bills, advertising, meals. Now let's see. Let me go back into office equipment, supplies, utility bills. Okay, so I've got the internet. Obviously, I've got the internet, or else you wouldn't be able to watch me right now. A portion of my internet bill is considered a business expense, because I'm treating YouTube as a business. A portion of my electricity to run my microphone, to run my computer, to run any part of my stuff is a business expense. All my eBay stuff back in my garage are in totes to keep them protected, to keep it dust-free, pest-free. Those totes are business expenses because it's part of keeping my eBay stuff organized and clean. Those are just some examples, just to give you some more examples of what I'm talking about. Okay, we're still talking about things to keep for 3 years. Receipt that back. When I bought my home 3 years ago, I redid the insulation in my roof. And not the installation in my roof, the insulation in my attic. That is an energy saving. However, I didn't have a business. I didn't have myself registered as a business at that time, so I can't deduct that. However, I did just replace my front door and my back door. Improvements to my home, and since my home is a home-based business, a portion of that can be wrote off for taxes. Okay, now we're going to go on to 7 years. Laverne Dorsey says, this is good information, Kenya. Thank you. Thank you very much. I hope I'm giving value out to people. Something that you can use, listen to it now, come back to it later. And then also, I encourage you to go out if you can, if you're able to go out and get this book on your own, this magazine on your own. This is the Essential Tax Guide 2020 edition. And if not, I will try my best to read kind of slow so that you can go back and screenshot some things if you need to, and then maybe bookmark where I'm talking about certain things. Okay, 7 years. What do you keep for 7 years? All supporting records for any claimed loss of worthwhile securities or debt deduction. I have no idea what that means, but I'm going to read it again so that you can understand. For 7 years, you want to keep all supporting records for any claim loss of worthless securities or bad debt deductions. I have a feeling that securities has something to do with maybe investments, if you're investing in a business or something. If I'm wrong, correct me, let me know in the comments section. And you also want to keep for 7 years bad debt deduction. So most of my items, like my business structure, I don't think I really have any losses. Yeah, I don't think I would have any losses. Like I don't sell a thing. This is just me assuming what this means. I don't sell something and then send it out as an invoice, right? I don't send an invoice is like basically a reverse receipt, like or it's a bill. I'm selling things, I give somebody an invoice and they don't pay it back. That's a bad debt to me. When you charge up an account and you don't pay it off, that's a bad debt to the company or to the business. And so a bad debt deduction is something you want to keep track of for 7 years. And forever, what do you keep forever? Each year's tax return. Each year's tax return. So from the moment you have your first job or your first income all the way to now, you want to keep every one of those tax returns. I hope that was helpful. I'm going to drink some warm tea and go on to the next section. All right. Oh, where did I say I was going to go? I was going to start talking about some retirement items, right? The first one I'm going to go to is on page 67, talking about retirement savings and taxes. Retirement savings and taxes. I'm gonna update my title just a minute ago. 2020 Tax Guide Magazine read through. Come chat and learn. Let's talk. Get ready to file your taxes. There. All right. So on page 67 is talking about retirement savings and taxes. The government provides many tax advantage tools to encourage you to save for retirement, including retirement accounts and tax credits. These tools help you reduce your taxes, which in turn allows you to save even more money. The tools that you decide to use will depend on whether you want to lower your taxes now or in the future. Here's what you need to know about the tools that are available to you. The Wiz says, hello, hello. I am just now reading my first article about retirement savings and taxes. This, let's see, we got pre-tax retirement accounts and we have after-tax retirement accounts. And I'm going to break those two down for you. Pre-tax retirement accounts. Pre-tax. You can contribute to some retirement accounts with pre-tax money. What does that mean? That means the money is not taxed before you put in your money. You put it in your account. These accounts, which are also called tax deferred accounts, offer you a way to reduce your tax bill now. So let's say you got $2,000. You want to put $2,000 in your retirement account. That money's not going to get taxed. You're going to put in $2,000, and that entire $2,000 is going to go into your retirement fund, and the interest is going to build up little by little by little without you paying taxes right now. You have to pay it later. Common pre-tax accounts, if you're wondering what types of accounts there are 401s. So I'm going to type something in the chat. I'm going to type something in the chat so you guys know what's going on here. And you can also use, if you go back and watch this live stream, take a look at the timestamps that I'm writing, and that will help you kind of use them as a bookmark so you can go back and see what I was talking about. Right now I am talking about retirement savings and taxes. And these are the pre-tax retirement accounts. If you are young and think you do not need this information, au contraire, mon frère, and au contraire, mon frau. My brothers and sisters, trust me, you need to save a little bit now. Out of sight, out of mind. Save it where you don't even know about it. And it's going to be growing behind your back, and it's going to be growing and growing and growing. And trust me, you hit 40 pretty quickly. 40 is right around the corner from me being able to retire. And I want to be able to look at my nest egg like, ooh la la, I have all of this beaucoup money. But if you don't think about it till later, then you got to make up for lost time. So yes, young people, my young people, pay attention. You are going to need to know this. Okay, so these are the pre-tax retirement accounts. They are as followed: 401k, traditional IRA, simple SIMPLE IRA, and there's another one, and then I'm going to start reading again. SEP. Okay, we got pre-tax retirement accounts: 401k, traditional IRA, simple IRA, and SEP. So if you go back later and watch this live stream on the replay, you should be able to look in the live chat, and you can toggle the timestamps on and off. Sometimes you can see the time, sometimes you can't. You got to toggle it, and then you should be able to kind of go and find out where I'm talking about this. All right, let's talk about those pre-tax retirement accounts. What is a 401k? A 401k is an employer-sponsored. I need sponsorship. Will somebody sponsor me? Please come sponsor my channel. A 401k is an employer-sponsored retirement account that allows you to set aside a portion of your paycheck before taxes are taken out. Remember, we're talking about pre-taxes right now. Pre-tax retirements. This serves to reduce your taxable income. What does that mean, Kenya? It means at the end of the year, when Uncle Sam starts digging in your pocket, he's going to say, oh, you made this much money. And you're going to say, oh, well, I made this much money, but this much money went to my retirement account. So you can't tax me on all of this. You can only tax me on this much. Get it? Okay, this serves to reduce your taxable income. How much can Uncle Sam tax you for how much money you've made? Got it? This serves to reduce your taxable income, lowering the amount you have to pay in your income taxes. Your employer may contribute to the account as well. For example, let's say you make $50,000 in a year and your employer offers a 3% match. I'm not that good in math. I want to say it's $1,500. Is it $1,500? I'm going to use my calculator. I'm cheating, I know. Anybody who knows what is 3% of 50? What is 3% of 50? $50,000, put it in the chat. But I'm pretty sure I'm going to type it up faster than you can. $50,000 times 0.03. $1,500. Yeah, that's what I said. Okay, so. Oh, the answer was in there. All I had to do was finish reading. All right, so for example, let's say you make $50,000 a year and your employer offers a 3% match. If you contribute at least 3% of your annual salary, that means if you put $1,500 of your own money in there, your employer will put an additional $1,500 in your account. How much is that, boys and girls, ladies and gentlemen? That's $3,000 because you put in your own money and your employer put in the exact matching amount. It says here, most plans offer participants a choice of mutual funds to invest in. I'm going to look that up real quick just to make sure I tell you the right thing. In case you're wondering, what is a mutual fund? Does anybody know what a mutual fund is? I kind of know what it is, but I kind of don't. So I'm just going to copy and paste. I'm literally going to copy and paste into the chat room so you will know what a mutual fund is. Because as I'm reading through this, I want you guys to have a full understanding. All right. A mutual fund is an investment program funded by shareholders that trades in diversified holdings and is professionally managed. So we're not talking about stocks and bonds per se, but kinda. It's not you investing in the stock market. It's like a company that is watching certain stocks and they're making the investments for you. It's a mutual fund. An investment program funded by shareholders that trades in diversifieds. You need some diversity. Diversified holdings and is professionally managed. I hope that helps. If anybody has a better example or a better definition, always feel free to put in the comments or in the live stream. All right, so most of these pre-tax plans, they will offer you a choice of mutual funds to invest in. The money in your 401k has the potential to grow tax-free. That's a good thing, to grow without being taxed, until you begin making withdrawals in retirement. At that point, when you're retired and ready to start taking money out, that's when you have to pay taxes on it. At that point, your withdrawals will be taxed as ordinary income. There are some restrictions on 401k accounts, including contribution limits, which means you can't put all your money in there. They do cap out. They only allow you to put in so much. So it's telling me to look at retirement accounts. Look at retirement accounts at a glance. That's on the next page. Okay, now we're going to move on to traditional IRA. A traditional individual retirement account, that's what that stands for. A traditional individual retirement account is another form of tax-deferred retirement savings. If you meet certain requirements, your IRA contributions are tax deductible, which helps you to lower your income tax now. Just like with the 401k, there is no tax impact on your earnings until later on when you start taking that money out. A custodian, such as a bank or a retail broker, holds the account, and you will typically have a wide range of investment options available to you based on the offerings of your custodian. So whoever is holding your money, they will have different perks and options for you. I got 9 viewers and 6 likes. I appreciate it. Now we're going to move on to the simple. What is a simple IRA? Simple. S is savings, I is incentive, M is match, P is plan, employees is E. So a simple IRA is a savings incentive match plan for employees. That kind of sounds like the 401k, doesn't it? Savings incentive match for employees. IRA can be opened by any employer, including self-employed individuals. I didn't know that. As with the 401k plan, a simple IRA lets employees make pre-tax contributions. Employers must take matching contributions or non-elective contributions, which are paid to the employees whether or not they contribute themselves. Hey, I like that. That means they're going to give me money whether I invest or not. That's awesome. But of course, it's to your advantage to put your own money in there. Let me read that again so we all understand. As with a 401k plan, a simple IRA lets the employees make pre-tax contributions. The employers must make matching contributions or non-elective contributions, which are paid to the employees whether or not they contributed themselves. Okay, so from what I understand, there are 2 different things going on here. The matching contribution is if you take money out of your pocket, that you've earned, and you put in that account, your employer has to match it. If you choose not to, that's the non-elective. You are electing not to contribute, but the employer still has to give you some money. are paid to the employees whether or not they contribute themselves. Employers can take a tax deduction based on their contribution. So if I have a company and I got employees and I've got this plan, what I can do is I can take my own tax deduction. Hey, Uncle Sam, please don't tax me so much. I got these employees over here, and out of my profits, I'm helping them with their retirement savings. So back off. That's what that's saying in so many words. Employers can take a tax deduction based on their contribution, and withdrawals from the account are taxed as ordinary income. With the IRA, Life of Key says, with the IRA, you can have tax taken out in the beginning or after. I don't know if it's a choice. I think it's either or. These are two different types of accounts. Pre-tax retirement accounts and post-tax retirement accounts. So the ones that I just mentioned, the 401k, the traditional IRA, the simple IRA, whatever money you put in right there, right now, it's not being touched. It's not being taxed at all. It's going in just the way it is, and you're earning money on it, and you don't get taxed on it until years when you're able to retire. Here's a pro tip. Saving a small amount for retirement will not have a big impact on your tax bill, but can move you closer to your long-term goals. So if you don't want to, if you're like in a bind, you're like, oh man, my budget doesn't really help me out right now. I don't have that much money. It says right here, even saving a small amount, it's not going to have an effect on your tax bill, but it will bring you closer to your long-term goals. Do you know why? Interest, especially compound interest. 10 years goes by like that. And that $100 that you have in there could easily be in the thousands of dollars in 10 years. Okay, now we're going to talk about, oh no, I've got two more. I've got one more. This is the SEP IRA. Did I put that in there? Yeah, I talked about the 401k. I talked about the traditional IRA. I talked about the simple, and now I've got the SEP. So the SEP, you down with SAP? Yeah, you know me. Sorry, I couldn't help myself. Okay, the simplified employee pension. That's what that is. Simplified employee pension. I'm actually going to write these out because right now I've just got the acronyms. So I'm going to write those out. So in case anybody didn't know, IRA equals individual retirement account. Most people know this, some people don't. Let's see, simple, what did I say that was? Savings incentive, match plan for employees. And then the SEP is simplified employee pension. Simplified employee pension. Okay? I have no idea what 401k stands for. I think that is a tax code. Like if you read the tax books and they have it broken down by paragraph and by sections, I think that's where 401k comes from. Because it gives you the definition, but it doesn't really tell you what 401 means. All right, we ready? Let's go on to SEP IRA. The SEP IRA is the simplified employee pension, which is a traditional IRA designed for self-employed individuals like myself. Well, actually, I don't completely work for myself. I just have my own business off to the side, but I still have an employer. Any business owner with one or more employees can open one, as can anybody with a freelance income. Only employers may make contributions. These contributions are tax deductible for the business owner and are held in an SEP account in the employee's name. Withdrawals are subject to income tax. So I don't have any employees. I do everything on my own. I'm a sole proprietor in my eBay business and in my YouTube and in my voice stuff. So I don't have any employees that I would actually contribute to. Okay, now we're going to talk about the after-tax retirement accounts. After-tax retirement accounts. And these are the types that there are. There is the Roth IRA, and the Roth 401k. Yes, the Roth IRA and Roth 401k. So these are the two types of retirement accounts that you can contribute to, that the money will be taken out right now. So whatever money that you put in, if you put in $2,000, whatever your tax bracket is, it's going to get taxed, and then it's going to go in there, and then later on when you get ready to take it out, it's not going to be taxed again because you've already paid taxes. All right, after-tax retirement accounts. Retirement accounts that use after-tax dollars are not taxed when you withdraw from them in your retirement. If your tax burden at that point is lower than it is now, however, you will end up reducing your lifetime tax burden. Here are two frequently used after-tax accounts. The Roth IRA. The main difference between a traditional IRA and a Roth IRA is that Roth IRAs are funded with after-tax dollars. Your contributions and earnings grow tax-free, and your withdrawals generally are not subject to income tax. Contributions are not tax deductible. Though you won't see your tax benefit now, you will benefit by paying no income tax later when you withdraw the funds. It says here the Roth 401k, which is the other type. Life of Key says it taxes a certain percentage. Yes, it does. I don't have the answer to what percentage, but yes, it taxes a certain percentage. I'm only assuming that it's whatever your tax bracket is. So somebody who makes 6 figures a year is not going to be taxed the same as somebody who makes, $20,000 a year, or somebody who makes $50,000 a year. All those different people, they're going to have their money taxed at different rates. The Roth 401k functions just like a traditional 401k, except your contributions are made with after-tax dollars and are not subject to tax when you make withdrawals in retirement. These accounts are often used by people who plan on their tax bracket being higher in retirement than now. So what does that mean? It means if you're in a company where you're making a certain amount of money now and you're planning on staying with that company, or maybe you're planning on getting more education, you're planning on making more money now, whatever it is that you do now, you're making $50K now, you're thinking to yourself, man, in the next 15 years I should be making at least $200,000. So you're planning ahead, thinking that you're going to be in that next tax bracket, and so you are going to benefit from this Roth 401k. You're in a certain tax bracket now, so you're only paying a little bit on your taxes, but you're planning on making more later. And so that's why you want to choose this Roth 401k. These accounts are often used by people who plan on their tax bracket being higher in retirement than it is now. It also says here, you can make your contributions for the tax year 2019 all through April 15th. So 2019 is gone. However, until it's time to file taxes, you can still make contributions to that account because it's still considered part of last year. And I'm going to hold this up to the screen just so you can see it for yourself. You can make contributions for the tax year 2019 to all IRA accounts all the way through April 15, 2020. Contributions to your 401k must be made by December 31st. Let me make sure I understand that. IRAs can be made all the way through April 15th. 401k, the last time that you can make your contribution was the last day of last year. Be sure to comply with income and eligibility requirements for the account you select. So let me hold this up so you can see that breakdown here. Depending on if you have an IRA or a 401k, you can make Your account, you can make contributions to your account up until the last day of the year in 2019, or you can make contributions all the way up to April 15th. You see that there in the highlighted section? Life of Key says it depends on who you partner with and also the tax bracket. Yes, this is depending on the type of retirement account and your tax bracket. All right, now let's go on to retirement savings contributions credit. When you contribute to your retirement plan, you may be able to take advantage of the retirement savings contributions credit or savers credit. I'd never heard of that before. A savers credit? Now, I've heard of the child tax credit. I've heard of the educational credit, but I didn't know you could take credit for being a saver. Retirement savings contributions credit. When you contribute to your retirement plan, you may be able to take advantage of the retirement savings contribution credit or the savers credit to reduce the amount you owe on your tax dollars for dollar. To claim the savers credit, you must be 18 or older, and you can't be a full-time student or be claimed as a dependent on anyone else's taxes. Okay, all three of those apply to me. I've still never taken advantage of that. I'm over 18. I've never been a full-time student, at least in the last 10 or 15 years, and nobody can claim me as a dependent, and I contribute. I contribute to my 401k. So how come I've never heard of this? The amount of the savers credit is equal to a percentage of your contribution, up to $2,000. And it also depends on your filing status and your AGI. Y'all know what the AGI is, right? The AGI is the adjusted growth income. So that's whatever your previous year's earnings were. So I'm going to put that in the chat room as well. AGI equals adjusted gross. Is it gross or growth? I think it's gross. I'm going to do a quick copy and paste because I don't want to misspeak. All right, adjusted gross income is calculated by making the above line adjustment to a taxpayer's gross income. AGI reported on the IRS form is used to calculate an individual's tax liability. Oh man, all the honey went to the bottom. Where are we at? Oh, that's it. That's it. The amount of the savers credit is equal up to a percentage of our contribution to $2,000 and depends on your filing status and adjusted gross income. The chart below can help you calculate this credit for 2019. So let me hold this up to the screen so you can see. This is the chart that they're talking about. Let me not talk too loud because I'm really close to the microphone now. According to this chart, this is the retirement contribution credit. If you are married and you're filing your taxes jointly, you can have a combined adjusted gross income up to $38,500. Or if you have an AGI up to $28,875 as head of household, or if you're anybody else and have a adjusted gross income up to $19,250, you are going to get a credit rate of 50% of your contribution. If you're married filing jointly and you have the amount earned in that second row, or if you're a head of household with the amount earned in that second row, or if you are another filer with the amount earned in that second row, you are going to be able to get the credit of 20% of your contribution. If you're married filed jointly and you make that much in the bottom row, or if you're the head of household and you make that amount in the bottom row, or if you are another filer making the amount in that bottom row, you are going to be able to get the credit rate of 10% of your contribution. I'm going to put retirement contribution credit in the live stream, so if you want to come back later and look at the timestamp, you will be able to see what I'm talking about. Retirement contribution credit. Retirement contribution credit. Okay, so if you come back to the replay, hit the timestamp. It says it's 1:05 p.m. right now. So it's telling me the time right now, but it's actually going to do the time of the live stream, which right now we are at 1 hour and 11 minutes. In either case, you should be able to find where I'm holding this up on that portion. All right, does anybody else have any questions before I go on to the next section? That was the first article on retirement savings. If I don't have any more questions or something or any other requests, what I'm going to do is just go on to that next section, which is the top states for a tax-friendly retirement. Anybody thinking about moving once they're ready to retire, moving to a different state? Any questions? Any questions? I'm going to go on to page 90, unless somebody has something pertaining to something else, and then I'll look for the answer in the table of contents. I'm going to wait a little bit because I know there's like a 20-second lag between what I say and what you guys hear. Wow, while I'm waiting, I'm going to share this picture with you guys. I'm looking at this picture of a Florida community. This is like really awesome. Look at this community. I don't know what kind of infrastructure you would call this. But do you see how this place is built up? There's the ocean in the background. There's the ocean in the background. It looks like there's some city life going on there in the background as well. And then this neighborhood is like built on canals, like instead of streets. That is awesome. Instead of streets, this neighborhood is built off of canals. You see that? And instead of cars in the front yard, they've got boats. Wow. All right. I don't see anything in the chat room, so I'm going to go on to the next article, which is the one that I was holding up to the screen. These are the top states for a tax-friendly retirement. So let me type that into the chat. So if anybody's coming back to watch this on the replay, now let's read about top states for a tax-friendly retirement. There are lots of factors to weigh when choosing where to spend your retirement. Climate, proximity to family, access to quality medical care. And if you're looking to make the most of your retirement income, you'll want to add taxes to the list. So when you're ready to retire, you're looking to see where you might want to move. You're thinking about climate, how close is your family, what type of medical care is around, and what are the tax benefits. The state you live in can have a big effect on your tax burden. Here are 7 good choices for stretching those retirement dollars. First on the list is Florida. With its plentiful beaches and balmy weather, Florida is a popular hub for retirees, but the benefits extend beyond the abundant sunshine. Florida has no state income tax. That means the residents don't pay state tax on Social Security benefits or other retirement income. Florida also has no inheritance or estate tax and offers a generous homestead exemption to offset property taxes for qualifying seniors. No inheritance tax, no state tax, estate tax. Hold on, let me enunciate so you can hear me. No state tax, no estate tax. That means whatever your home is or your property, that is your estate. You're not going to pay taxes on that when you pass or if you want to give it to your family. Your inheritance, whatever you want to give to your kids, there's no tax on that. No inheritance tax, no estate tax, no state tax, and it offers generous homesteading exemptions to offset property taxes. So a homestead, I mentioned this earlier when I was talking about one of my YouTube friends. Her name is Robin. She lives in Maine. Her channel is called Pt.1 Cooking Mama's Homestead. She is a homesteader. That I don't really know the exact definition of it. I know what it means, but I'm gonna give you guys a quick definition. Homesteading is a way to reduce your taxes. It's basically saying, hey, do not tax my property as much because I'm living off the land. I'm going to give you a definition, and then I'm going to give you two definitions actually. This is the definition of homestead. In case you've heard it, but you didn't really know what it meant. This is the definition of homestead. Oh no, it's not letting me put the whole thing in there. I don't know what just happened. I just looked at my software and it said I was no longer streaming. So I don't know if I think I might have accidentally hit a button there. So I apologize. Thank you for letting me know. I looked up, I said, why am I getting the circle of death on there? Buffering. All right. So all I was doing right now, thankfully I wasn't reading. But all I was doing right now is I was giving you guys some definitions. You're back. Yes, I am. You know what? I think I know what I did. So I'm going to move this out of the way so I don't hit that button accidentally again. Okay. I should be good to go. So all I was doing was copying and pasting two definitions. I was getting ready to talk about some of the benefits of different places that you might want to live when you're ready to retire, and talking about Florida. I don't know if you guys heard me read about Florida. If I started buffering before or after Florida, let me know. If you heard Florida, type in the word Florida. If you didn't hear any of that about retirement, say please just type in start again. But all I did, I was reading the first portion. Of tax-friendly states. So if you heard me read about Florida, type in Florida. If you didn't hear anything for the last 5 minutes, type in start again. I was talking about Florida's homesteading exemptions, and that's why I put in the Florida. Okay, so you heard me say Florida. So let me read that part over again, and then I will refer to what I just wrote. It says Florida has no state income tax, no inheritance tax, no estate tax, and they offer a generous homestead exemption so that it will offset your property taxes. Then I took a moment to do a copy and paste. Look over in the live chat. That's what you're going to see. You're going to see, in case you're wondering, like, what the heck is a homestead? And what is a homestead exemption? So homestead exemption is a legal regime to protect the value of homes of residents from property taxes and creditors and other circumstances that arise from the death of the homeowner's spouse. Such laws are found in the statutes of the Constitution of many of the states in the United States. So it is something that doesn't automatically happen when you become an homeowner. It's something you have to apply for. The first year and a half or the first 2 years I owned my home, I forgot about this exemption, and it reduces your taxes. So whatever I have to pay my property taxes for as just a regular homeowner, I would pay a certain amount. If I apply for homesteading, then I apply for it and they will take less off. Let's move on to Louisiana. Are you planning on moving to Louisiana for your retirement? While Louisiana residents do pay state income taxes, income from Social Security and military, civil, local, and state governments pensions is exempt. So if you get your Social Security and you're living in, well, that doesn't make sense because I thought Social Security was already exempt. You pay taxes on Social Security? Why did I not know that? Hold on. Let me read. While Louisiana residents do pay state income taxes, income from Social Security, income from military, income from civil, income from local and state government pensions is exempt. So if you get a pension, it's exempt. Residents over the age of 65 may also be able to exclude up to $6,000 of retirement income from their taxable income. Louisiana's property tax rates are among the lowest in the U.S., making the state appealing, especially for fans of Cajun Creole food, music, and culture. Florida, okay. Nevada, with no income, estate, or inheritance taxes, Nevada is just another popular retiree destination. Wealthy retirees planning to pass their wealth on to their heirs may also appreciate the state's generous asset preservation laws. For retirees who are more interested in the outdoors than slot machines, check out Reno. Reno is known for its 300 days of sunshine per year, proximity to the Sierra Nevada mountains, and the world's largest free hot air balloon festival. I have an auntie that works out in Las Vegas, and so she probably knows a lot about these types of tax laws and tax exemptions. Let me read that again just so you guys understand. Nevada has no income tax, no estate tax, no inheritance tax. It says it has a asset preservation laws. You can look that up on your own. Asset preservation laws, Nevada. And yeah, on to New Hampshire. Retirees looking to enjoy the best of all four seasons should consider this New England state. New Hampshire only taxes income from dividends and interest and offers a $1,200 exemption for residents 65 and older. It's also one of a handful of states that does not levy a sales tax and has one of the lowest crime rates nationwide. What? No sales tax? That means when you go to buy things, you're not going to get taxed on the things that you're buying. No sales tax. Let's move on to Pennsylvania. Pennsylvania does not tax Social Security or most income from pensions, and the cost of living tends to be lower than in nearby New Jersey or New York. However, the Keystone State generally does levy a state inheritance tax on assets that you may want to pass on to your heirs other than a spouse. Retirees might look into Bethlehem, which is a former steel town that transformed its mills into an art center. Bethlehem also earns praise for its walkability and affordable housing. So that might be something to consider if you know that you're going to be active as a retiree. It has a high walkability score, which means you don't need to have a car to get around. Everything is in walking distance. Now let's move on to South Dakota. South Dakota has no individual income tax, so retirees won't have to dish out taxes on income they receive from Social Security, pensions, or retirement plans. The state also has no inheritance tax and a low sales tax of 4.5%. What is the sales tax where you live? In Texas, I believe it is 8%. 8 point something percent. What is the sales tax in the state that you are listening from? Make sure you let me know in the comment section or in the live chat. What is the sales tax? Here in South Dakota, it is only 4.5%. In Texas, it's 8. I think it's 8. I want to say 8.25. Let me look. Let me look and see. What is the sales tax in Texas? Oh, 6. Where did I get 8 from? 6.25. 6.25 is the state sales tax here in Texas. Where did I get 8 from? Maybe I'm thinking of Michigan. I used to live in Michigan, so I might be thinking of I don't know. I don't know where I got that from. All right, let's see. We got Wyoming. Oh no, let me finish South Dakota. The low cost of living and highly rated healthcare make South Dakota among the most desired retirement destinations. A favorite location among retirees is Rapid City, located near Mount Rushmore, which is the national memorial, and boasting some of the area's best medical facilities. In Wyoming, what do we got in the chat? 6%? Okay, 6%. With its low crime rates, low property taxes, a low sales tax of 4%, dang, Wyoming got them beat. Wyoming is an affordable destination to retire in, so long as the brisk winters don't scare you off. For retirees seeking culture, check out Casper, which has a sales tax of 5%. Wyoming's second largest city, or Laramie, with a sales tax of 6%, home to the University of Wyoming. Well, Texas was definitely not on this list. So if you're thinking about retiring and you want to save as much as you can on your Social Security taxes and other benefits, don't come to Texas. That's what they're saying. These are the top states: Florida, Louisiana, Nevada, New Hampshire, Pennsylvania, South Dakota, and Wyoming. All right, I've got one more article to read on retirement before I move around in this magazine. And we got about 48 minutes to go on this live stream. Unless some more people come in and request some more information. Okay, saving for retirement. This is page 105. Saving for retirement. Y'all ready? Saving for retirement. I want to keep that picture up there so you can see it. Retirement may feel like it's in the distant future. Near-term goals, such as saving for a new car or even a child's education, may feel more pressing, but it's critical to start saving early. For one thing, saving for retirement can qualify you for big tax breaks. And the sooner you start, the more time your money has to grow, and the better off you'll be in retirement. The government offers a multitude of tax advantages to encourage you to pad your retirement accounts now. Check out the incentives below. Here's the first point. If you grow your retirement savings tax-free. So we already learned about this in the 401k article. Investment earnings in a retirement account like a 401k or a traditional Roth IRA are free from annual taxes. That leaves more money for you to reinvest in pursuit of additional tax-protected growth. If you're able to max out your retirement account or your intended annual contribution all at once, making that contribution early in the year could be beneficial. Depositing one lump sum gives your money more time to grow throughout the year, potentially increasing your investment returns. The second point here, it lower your taxable income now. You can significantly lower your income tax bill if you contribute to a traditional 401k or traditional IRA. These accounts are tax deferred. You can subtract your contributions from the income you report on your tax return, and the money will be taxed when you eventually withdraw it. In 2019, you can contribute up to $19,000 annually to a 401k if you're under 50, and an additional $6,000 if you're 50 and older. The limit is $6,000 for IRAs, and an extra $1,000 if you're 50 or older. I forgot to type in what I'm reading now. So if anybody wants to come back to this portion on the replay right now, I am reading about saving for retirement. And there should be a timestamp on there if anybody comes back to watch on the replay. There's a third point for saving for retirement. You can make tax-free withdrawals down the road. Roth IRAs are different from traditional IRAs in that you cannot deduct your initial contribution from your taxable income, so you won't get an immediate tax break. But a Roth IRA still grows free from annual taxes. And withdrawals that you make after the age of 59 and a half are completely tax-free, as long as you've held the Roth for at least 5 years. For taxpayers who expect to be in a higher tax bracket later in life, tax-free withdrawals can be an important benefit. The fourth point on saving for retirement, you can cash in on tax credits. Contributing to retirement accounts may qualify you for the 2019 Savers Tax Credit. This credit, formerly called the Retirement Savings Contributions Credit, is available to low and moderate income taxpayers. It equals a percentage of the qualifying taxpayer's retirement contributions up to $2,000 per year. And that, ladies and gentlemen, is why I've never heard of it. Two different reasons. It's called something new, and I would not have qualified for this. It says this is for low, that tax credit, savings tax credit. One, it used to have a different name. It used to be called the Retirement Savings Contributions Credit. And two, I'm not low income, and I'm not I'm considered moderate income, but I think I would not have qualified for this, which is why I have never been able to take advantage of it. All right, let me finish reading. While saving for retirement requires planning, the payoff is greater financial health in your future. The tax benefits available to you can make reaching your savings goals more achievable. All right, I think I'm going to move on to organization. I didn't see anybody chime in about anything else I should read, so let's talk about getting organized. Because I found a couple things interesting in here. Let me jump back to the beginning and talk about, this is Income Tax 101 for people who may need just a little beginner section on understanding how to do taxes. I'm going to start off, and there's going to be 3 articles I'm going to read. What is a progressive tax code? How to know what's taxable, and understanding tax credits and deductions. Y'all ready to go back to school? Let's go back to school. This is Income Tax 101. The U.S., United States, uses a progressive tax code, but what does that mean? Let's learn about it. The U.S. uses a progressive tax code, but what does that mean? Income tax, a tax on money made from jobs and other sources, is the single largest revenue source for the United States government. Originally controversial, it has since become the cornerstone of the U.S. tax code and is used to pay for public goods like roads, schools, libraries, and first responders. While tax rates are always changing, the U.S. tax code has been progressive since the 1860s, and here's what it means for you. Progressive versus regressive versus flat taxes. Under a progressive tax code, people who make more money are taxed at a higher rate than those who make less money. For example, if people make $10,000 per year have to pay 10% of their income in taxes, while those who make $50,000 per year pay 20%, and those who make $100,000 per year have to pay 30%. That is a progressive tax. So as you progressively make more money, you are progressively paying more taxes. A regressive tax is the opposite of a progressive tax. People who make less money are taxed at a proportionately higher rate than people who make more money. Under a regressive tax code, someone making $100,000 per year would owe a smaller percentage of their income in taxes than somebody making $10,000. Meanwhile, a flat tax, let's say 10% of the income, imposes the same proportional tax on everybody regardless of their income. In this scenario, higher earners and lower earners pay taxes that are roughly equivalent to each other. A flat tax would make filing taxes easy, but perhaps not as fair for all U.S. taxpayers. As complicated as doing your taxes can be, there are good reasons for having a progressive tax code. First, it increases government revenue by collecting more money from those who can afford to pay more, generating more money for important public services. Second, it eases the burden on lower earners and gives them a greater chance to achieve success. Third, it helps to correct imbalances that occur due to rules that result in dividends and capital gains being taxed at a lower rate than other forms of income. So you guys get that? That was a breakdown of 3 different tax rates. There was the progressive taxes versus regressive taxes. I don't know who would think that's a good idea. Who thinks regressive taxes are a good idea? Versus flat tax. And of course, that doesn't seem like a good idea either. If everybody's paying the exact amount of tax, people who are not making a lot of money have to pay a certain amount, and millionaires, billionaires, and people who are well off, that's like chump change for them. Some people might think that's fair. What do you think? Let me know in the chat or in the comment section. Which would you prefer and why? Progressive versus regressive versus flat tax. Okay, now let me move on to the second part of this article here. It says, understanding tax brackets, not all income is taxed the same. So I'm going to type that in here so people can know to come back to this portion. Understanding tax brackets. Okay. Our progressive tax works by placing earners into different tax brackets according to how much money they make. There are currently 7 official federal tax brackets with rates ranging from 10% to 37%. So these are new and recent changes. However long you've been paying taxes, whatever tax bracket you used to be in, things have changed. There are currently 7 tax brackets. I think everyone should pay the same tax. So 10% of whatever you make. Do the math on that. If you are a millionaire and you pay 10% of $1 million, and if you pay, you make only $10,000 a year, 10% of whatever that is, I don't know what the benefits of that would be. Or maybe it's not even a percentage. Maybe it's a dollar amount. That would not be cool. If everybody had to pay $5,000, I don't think a rich person would even feel that in their pocket. But somebody who's like low income, that might be a stretch for them. Okay, let's talk about, and thank you for that input. Thank you very much for that input. Let's talk about the tax brackets. Our progressive tax works by placing earners into different tax brackets according to how much they make. There are currently 7 official federal tax brackets with rates ranging from 10% to 37%. The dollar amounts that define the brackets change depending on whether you are a single filer, married joint filer, or a qualifying widower. Married separate, which means you have a spouse, but you want to file your taxes separate and they file their taxes separately. Or head of household filer. To get an idea of how the brackets change based on your filing status, see the tax brackets below. I remember when I first heard of that, I was thinking that was a little bit divisive. Like, if you're married, you're supposed to be sharing everything. Why don't you file jointly? Well, let's say one spouse earns six figures a year. They're going to be taxed at a certain rate. And let's say you only earn $20,000 a year. You're going to be earned at a different rate. When you combine that money, it's going to be in that bigger rate. So if you earn $20,000 and your spouse earns $100,000, if you're filing jointly, that is a combined amount of $120,000. So you're both going to have to pay that higher tax, right? But if you file separately, you're in this bracket, your spouse is in this bracket, and it actually ends up being a little bit better because they may be paying a higher amount for the amount that they earned, but you're only paying a little bit. And then when you put that money together again at the end, you save a little bit of money. I didn't realize that in the beginning. I was just like, why would you want to file separately from your spouse? It depends. It depends. You should do whatever is better for your household and for your pocket. And let me reiterate, I am not giving tax advice. I'm not giving legal advice. I'm only making commentary based off of what I'm reading in this here magazine. Why is this even important? Why do you need to understand your tax rate? Determining which tax bracket you fall into is not as simple as adding up your total income and finding the correct row on the table. Instead, you must calculate your taxable income. And this is sometimes referred to as that adjusted gross income, that AGI, which is your total income minus the adjustments, deductions, and exemptions. U.S. tax filers can choose between subtracting a standard deduction or a list of itemized deductions. The standard deduction is a fixed dollar amount each year, while an itemized deduction can include child care expenses, charitable giving, education expenses, select business costs, mortgage interest, and certain medical expenses. If you are near the lower end of the tax bracket, deductions are probably not going to reduce your taxable income, but it will keep you in a lower bracket, significantly reducing the taxes you owe. No, it says if you're in the lower end of the tax bracket, deductions not only reduce your taxable income, but send you into a lower bracket. Once you've determined your taxable income, it's important to understand that not all of the income will be taxed at the same rate, unless you fall into the tax bracket for the lowest terms. So let's say you have a taxable income of $75,000. You earn $75,000 a year. The first $9,000, the first $9,700 is so earnings between $9,701 and $39,000 would be taxed at the 12%, and anything above that will be taxed at the third bracket. Hope you understood that. I'm going to hold this up so you can read this yourself and understand that if you make a certain amount of money, a portion of that will be taxed at that lower one, a portion will be taxed at the medium, and a portion will be taxed at the higher one. Okay, here we go right here. Once you have determined your taxable income, it's important to understand that not all income will be taxed at the same. Let's say your taxable income is $75,000. So you're going to chop that $75,000 up into portions. $9,701 is going to be taxed at the lower amount because that is the first tax bracket. People in the United States, some people do earn that much the whole year. So that bottom portion of what you make is going to be taxed at that lower amount. Then they're going to see whatever else is left over, which will be approximately $39,000 $475. That amount is going to be taxed at that second bracket. There are people who make $40,000 and less a year, and so that is why it's going to be taxed at that second bracket. But you still have money left over. Remember, you made $75,000 a year. So the remaining amount of that money is going to be taxed in the higher bracket. So we've got 10%, 12%, and 22%. The person who earns $75,000 is going to have a portion of their money taxed at 10%, a portion of their money taxed at 12%, and a portion of their money taxed at 22%. The top bracket that you fall into is your marginal tax rate. So somebody with a taxable income of $75,000 has a marginal tax rate of 22%. Their whole amount isn't getting taxed, just that last bit that we counted up. Let's see. Even though only $35,525 will be taxed at that rate. Although there are 7 main tax brackets, the percentage of income varies even between taxpayers in the same bracket. So here is the tax bracket. You can take a screenshot or you can look this up on your own. Ooh, this is so hard to do in the reverse camera. There we go. So these are the tax brackets. How much do you make in a year? Depending on how you file, single, married filing together, married filing separately, or head of household, you're going to fall into one of these brackets. But even so, the amount that you make, a portion of it will be taxed at 1%, and then the rest will be taxed at a different percentage. So we got 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Depending on how much you make a year, your money will, or you will fall into one of those brackets, and a portion of your earnings will be taxed accordingly. Life of Key says, I think everyone should pay the same tax. Well, maybe the low-income people should pay less than the billionaires should pay more. That would be the progressive tax. All right, let's go on to the next section. We got about 28 minutes left in this reading. If you guys enjoy this, make sure you give it a thumbs up. Let me know if I should come back and do a second reading. I'm only going to do 2 hours worth of reading today. But if any of this is really interesting or helpful to you, I will come back and do another reading maybe on tomorrow and cover some of the other articles. Now we're going to talk about, how do you know what is taxable? How do you know what's taxable? How to know what is taxable starts now. All right. Many people are already familiar with income tax since they're required to file a tax return every year, but that's just one piece of a bigger tax picture. Some taxes are automatically deducted from your paycheck. We all know that. Get that first paycheck, we're like, where's my money at? Some taxes are automatically deducted from your paycheck or paid when you buy something from the store. Others only apply under special circumstances. Plus, you may not be taxed on all of your income, and the income you are taxed on may be taxed at a few different rates. It can be helpful to have a firm grasp on the many ways that you are being taxed. Yes, you are being taxed. Well, if you're here in the United States, living and working in the United States, you are being taxed. And, oh wait, where did I get that from? It can be helpful to have a firm grasp on the many ways you're being taxed and where those taxes are going as you prepare your return this year. So what's the difference between income tax versus other taxes? I'm glad you asked me. Income tax versus other tax. Anybody still in the room or able to type safely if you're not driving or something like that, please type in the chat room, income tax versus other tax. Income tax versus other tax. And actually, I'm going to be doing some typing too because there's a couple. There's a couple here. We got payroll taxes. We got sales tax. We got excise tax. We got property tax. We got estate tax. We got gift tax. We have inheritance tax. Oops, wait. Okay, that's all the taxes. So those are the different types of taxes, and that's what I'm going to go over in the next 25 minutes or less. In addition to federal income taxes, you know, federal is the whole government. Federal means whole government. State means the state that you're in. In addition to federal income taxes, most states, though not all, charge an additional state income. That's why we have, look at your pay stub, you got state taxes, you got federal charges, as do some municipalities, which means do you live in a city or a township or a parish or something like that, you're going to be paying taxes there too. So in addition to federal income taxes, most states charge an additional state income tax, as do municipalities and school districts. Here are some common taxes you might be paying right now. Payroll taxes. These taxes are also known as employment taxes. They're automatically taken from your paycheck to pay for Social Security and Medicare. For the 2019 tax years, workers had to pay 6.2% of their first $132,900 worth of earnings. I didn't make that much, but if I did, I'd be paying 6.2% of that. For the 2019 tax year, workers had to pay 6.2% of their first $132,000 for Social Security, and then they had to pay 1.45% toward Medicare. Employers are required to match these amounts in both cases. So if you have a job, these automatically are coming out, and your employer, your boss, your company, your organization has to match that exact amount. The next section is sales tax. Life of Key says city taxes. Yes, city taxes. Thank you for that feedback. Sales taxes are collected as a percentage of purchase for goods or services. I haven't gone out to the store lately, but I need to stock up on some items. When I go to Target, which is my favorite store, most of you know from watching me, when I go to Target, they are going to charge me the amount for the stuff in my basket, and then they're going to charge me taxes on those items. Some things are not taxable. I think it's foods. Is it foods, right? Non-prepared foods are non-taxable. So you go to McDonald's. I hate McDonald's. I should have used another example. You go to your favorite fast food restaurant, you're going to pay the price of the combo plus taxes because they took the time to prepare it. You're going to pay taxes on that. If you go to your local grocery store and you buy them buns and you buy that hamburger and you buy that cheese, you're not paying taxes on it because it's not prepared. You don't pay taxes on food. All right, let me get back to the magazine. Sales taxes are collected as a percentage of a purchase of goods or services. They are charged only on the state and local level, but the tax rate varies from place to place. Some states have no sales tax, lucky, while others may levy a combined local and state sales tax up to 10%. Good grief! Where do you live at where you got to pay 10%? I would never go to the store. That would definitely be a homesteader. I'd be growing my own chickens, growing my own milk, growing my own vegetables. I would never buy anything. 10%? Woo! Sales taxes are an example of a regressive tax, since lower earners end up spending a larger proportion of their hard-earned money on them compared to higher earners. So that's that regressive tax. So I go to the store, I make more money than, let's say, my son, who is just starting off in life, with the minimum wage job. We go to the store, and if I spend money on, $100 worth of stuff, and there's taxes that are going towards that, I don't want to pay him, but I'm not going to feel him as much as him. He's not making as much money as I am, but we're paying the same tax, that same 6.5%. So he's going to feel it more than me. That's that regressive tax. Now let's talk about excise. I don't know what excise means. Excise taxes are similar to sales tax. They are charged when you make a purchase, but they only apply to certain goods and services. These are also called sin products. What in the world? Oh, such as alcohol and cigarettes. But one of the most commonly paid excises is on gasoline. Oh, I think I have seen that before. When you go to the pump, it will say something. There's a little label on there talking about excise tax, which is taxed by the federal government. Excise taxes are often applied on top of sales tax. So let me understand that. The next time I go to the pump and I pay for gas, I am paying my local sales tax, but I'm also paying an excise tax on top of it that Uncle Sam himself is taking out. Got it. Food. It's time for me to get some food. I'm going to go get some non-prepared food. Some food from my fridge that I paid for with no sales tax. Property taxes are levied on the state and or local level, but most often on real estate. Sometimes on other large purchases like vehicles. These taxes are calculated based on the property market value and usually go toward local or county services like garbage collection, road maintenance, and fire protection. Now let's talk about estate taxes. These are taxes on the assets that you pass on to your beneficiaries after your death, including cash, securities, insurance, real estate, and business interests. You guys know what a beneficiary is, right? A beneficiary is a person who benefits from you having had stuff. You pass on, you can't take it with you. Somebody has to benefit from it, and that is your beneficiary. Usually it's your child, your spouse, or some person or organization that you designate. That would be your beneficiary. So let's talk about these estate taxes again. Estate taxes are taxes that you have to pay, or somebody got to pay. You're not going to pay. You're going to be gone. Something that is paid to pass on to your beneficiaries after your death, including cash, securities, that means investments, insurance, real estate, and business interests. Not everyone has to pay estate taxes. Only estates worth more than $11.4 million are taxed, and only the value of the estate that exceeds that figure is subject to taxation. Some states also charge their own estate tax. Now let's talk about a gift tax. I have never heard of a gift tax. Gift taxes are similar to your estate taxes, but they apply to gifts you make to another person or entity while you're still alive. High-valued gifts are taxed, and the annual gift exclusion allows you to make gifts at or below a certain value as many people as you want. In 2019, the annual gift tax exclusion is $15,000 per recipient. Anybody wants to give a gift tax, please feel free. My email is kenya@40entp.com. Yes, gift taxes are applied if a gift exceeds the annual exclusion. So I guess just like businesses have write-offs, if they have a loss or if they want to donate something, they write that off, right? So a gift tax, you can just give somebody some money, and then at the end, when it's time to pay your taxes, hey, Uncle Sam, yeah, I know I made $50,000, but I gave $10,000 of that away. I gave some to him, some to her, some to them. That's a gift tax. It applies to another person or entity that you make while you're still alive. Only high-value gifts are taxed, which allows you to make gifts at or below a certain amount. So you can give out $14,999 worth of gifts. Just give it away. And as long as you claim it, you're not going to be taxed on it. That's cool. So I wonder, would it be illegal to organize an entity in your name or for your own benefit and just gift the money away. I'm definitely not giving tax advice. I'm just thinking out loud. Because I know that there are tax loops, and I know that there are things that the rich do to preserve their money. They're giving it away, but sometimes they still benefit from it. I'm just wondering, it says you can give that money away to another person or entity. Who is that entity? Is it the 40 Entrepreneur Drive entity? I'm just giving it away to this organization. It's called 40 Entrepreneur Drive, so please don't tax me on it. Let me stop. All right, let's talk about taxable income versus non-taxable income. And I think, oh man, I'm already at the 2-hour mark. And my phone died, so I don't know about my timer. I'm going to finish up this article here. And then I might come back on tomorrow if you guys are interested. We're talking about taxable income versus non-taxable income. In general, the income that you receive from any source is subject to federal taxation. This includes wages, salaries, commissions, interest, stock options, and dividends, unemployment compensation, rental income, and alimony. So your wages, you go to job, you get a wage. Your salaries, like I'm an hourly employee, but if I jump to the salary side, that would be my salary. Commissions, let's say you're an artist and somebody commissions you to do a piece of work and you sell it to them, that is your commission. Interest, so you made some money in the stock markets or in some other savings program, you have to pay taxes on that interest. Stock options, dividends, unemployment compensation, which I'm going to be applying in very shortly. Rental income and alimony. You get divorced, somebody is getting paid to keep being supported. I think they also call it palimony, don't they? Alimony goes to the woman, but if the woman makes more than the man and she was supporting him before they got divorced, she would be paying palimony. I think that's what it's called. It is also included in this is fringe benefits, such as company paid gym memberships, company vehicles, holiday cash gifts from your employer. All this stuff has to be taxed. And it includes other forms of income, such as canceled or forgiven debts or loans, money from offshore accounts, property that you obtain through barter, and payments from employer-paid disability or sickness and injury plans. Now, I totally disagree with that. You get hurt on the job, and your employer has to pay you disability or workers' comp. You got to pay taxes on that too? Man, that's a whole nother kind of wound. All right, it says here a few types of income are exempt from federal taxes. Knowing these exemptions could potentially reduce your bill. Some of the most common forms of non-taxable income include inheritances, gifts, and bequests. Most inheritances and gifts that you receive are not taxed. Note, however, that taxes are owed on estates that exceed the federal exemption, and it says to see the figure below. Life insurance payout. If you get something happens and you are able to cash out your life insurance, that is not taxed. Any money that you receive from a life insurance policy when someone dies is non-taxable. If you cash out a life insurance policy, though, that money is generally taxable. So you're paying on your life insurance. Right now you have a life insurance policy. It's for the purpose of if somebody dies, those last, what do you call them? Anyway, funeral expenses, things like that. Those last needs are taken care of. If there's money left over, that's not taxable. But if you're paying on insurance, and you say, hey, Geico, hey, well, maybe not Geico. What's the other health insurance? Hey, MetLife, hey, Aflac, can I get my money back? I just want to cash out. You're going to be taxed on that. What else is not taxed? Qualified scholarship money. Note that while money from a qualified scholarship is generally not taxable, any of that money that goes toward room and board is. Other non-taxable income, some of these sources include municipal bond interest, most healthcare benefits, child support payments, welfare payments, and cash rebates on purchases. Reduce your taxes by taking advantage of the full range of exemptions and deductions. So I'm going to put a little mark on these pages that I read to know that I read them already. And then I think I will come back. I'll come back probably tomorrow. I'll come back tomorrow and let's see. I read about the progressive tax code. I read about knowing what's taxable, and that's it. Ladies and gentlemen, thank you so much for your time. That has been me at home, hashtag at home, hashtag in my free time, reading about the 2020 tax guide. This is essential information. If you found this information helpful and you haven't already, hit the thumbs up button, hit the like button. Let me know that you liked it. In the comment section, let me know what you would like me to cover next. If you have a question, if it is covered in here, then I will definitely read the article. If it's not covered in here, I am not qualified to answer it myself. So keep that in mind. And yes, thank you very much for those who hung out with me, whether you're hanging out in the background and just listening, or if you're participating. I do appreciate you, and I will see you in the next live stream, either tomorrow morning when I'm reading the Bible, or tomorrow afternoon while I'm reading the 2020 tax guide. See you in the next video, and get those tax forms in place. See ya.
Thanks for watching, and don't forget to follow me on social media. Now, let me know what you think about this next upcoming video.